Hi there, welcome to another live webinar with us, Philip Nova, and with us in the studio is Martin Chong, Director of Portfolio Management with our sister company, Phillip Capital Management. And we'll be discussing the Phillip SING Income ETF. It's basically a smarter way to invest in Singapore, also known as one way you can beat the inflation by investing in quality Singapore companies. As we know, the context for today's webinar is, as we know, the Singapore core inflation hit a 14-year high at 5.1% in August 2022. Fighting the inflation in a volatile market is becoming even more challenging. Your cash in hand may seem vulnerable to inflation. How about diversifying your money into a AAA market like Singapore? Strong SGD and good quality companies will let you have a good night's rest. And many of these companies have regular dividends that will help you grow your passive income too. One way you can tap into the quality Singapore companies is via the Phillip SING Income ETF. And this ETF invests in high quality Singapore companies. I believe Martin will tell us more about later in a very short while. And it comes with semi-annual dividend distribution, which is an ideal investment tool to diversify your portfolio and beat inflation. What will we talk about today? The current market outlook, of course, threats and opportunities caused by the market turbulence, and a dividend trap, how not to get stuck in it, index performance, and the features of the Phillip SING Income ETF. And with us in the studio is, as I've mentioned earlier, is Martin Chong, Director of Portfolio Management for Phillip Capital Management. Martin is as mentioned, is the director, and together with the management team, he covers the group's business development and facilitates alliances amongst the institutional channels in the region. And during his time with Phillip Capital Management, he was involved in launching 6 ETFs, of which 2 were REIT ETFs in Singapore since 2016. Martin started his career with Malaysian government investment arm Permodalan Nasional Berhad, Malaysia in 1998, and moved up the corporate ladder subsequently. Prior to joining the company, he was with the UK fund management firm as a senior vice president, taking charge of business development in the Far East region. His career in sales management spans across asset management, agency development, fund platform, and online fund distribution. So I reckon we're in very good hands today, Martin. And before I hand the reins over to you to walk us through what you are going to share with us today, can I just do a quick check? Members of the audience, can you hear us loud and clear? All right, great. Thank you so much for the quick response. You can hear us loud and clear. All right, Martin, the members of the audience can hear us. It's over to you now.
Thanks, Sri. Thank you very much. Good evening, ladies and gentlemen. I'm Martin Chong. Pleasure to have you here. We are very excited, okay, because of the market volatility. At the same time, it gives us an opportunity to accumulate our wealth as well as investment. This is over time how we grow our investment for what one of the reason is for retirement, for savings, to grow our investment. All right. So the reason why we put the Singapore map here is that you can see, it's actually 700 square kilometers geographical coverage. Okay, this is where our country
hey Martin,
size, no?
Sorry to interrupt, Martin. I'm not sure if you are meaning to share the slides while you speak over them. I can't see the slides right now.
Oh, thank you very much. Thank you. Hold on to it, because I thought I already shared. Sorry. Can you see the screen?
I see the slides. Please put it on the
Okay.
presentation mode. Thank you.
Okay. Thank you very much. Thank you. Thank you. Give me a second. Okay. So you can see the QR code. Please scan for the fund documents. So it allows you to access to the fund documentation like fund fact sheet, prospectus, and some product highlight sheet. So from what I shared with you just now is that we talk about 700 square kilometers geography coverage. It's a small, tiny island in Southeast Asia, and actually, this geographical size, this size has been growing about 1/3 since our independent days. All right, so another 5 seconds to scan the QR code. All right, then we will move on to the next next slide. Okay, so let's move on. We have a video for you to see later through our sharing. It explains within 1 minute about this product, and too bad that we can't share this the sound. So then I will share with you the YouTube later. Okay, so let's move on. Something very close to us, very familiar. Singapore. So let's talk about the figures and facts that you may not know as well. Our GDP 2022-21 it's about close to 400 billion US dollar, and this is the third largest in ASEAN. Okay, after Indonesia and Thailand, quite close to the Malaysia as well, about 300 over billion US dollar. Only Indonesia reached 1 trillion size. Okay, and then populations of 5.4 million grow from the previous lockdown last year. I think we are now at 5.64, if I'm not mistaken, 5.6 million now. Okay, with the 3.5 million Singapore citizen and then 1.5 non-residents, including the employment pass as well as the work permit holder, and then PR always stand around 500,000 or 550, this range. Okay, so very important Asia's top asset management center. Okay, with 5.4 trillion under management, and then also very important financial center in the world, and also among the richest in the world, #1 in Asia. Okay, for the mean wealth per adult. All right, and then GDP per adult as well. Okay, so very important venue for the meetings, event like F1, Shangri-La's dialogues, and etc. etc. So this tiny little red dots is actually very important in Asia. Okay, also play a very important role in Southeast Asia as well. Okay, and then let's move on to the next slide. Okay, so when we talk about the dividends, we talk about investment. All right, you always hope that the investor always hope that we can receive dividend. All right, for those who would like to grow their money. So over time, we have developed some investment strategy with our partners as well as through our product offering. Phillip Capital Management is actually one of the retail fund management company in Singapore. All right, so we are the part of the Phillip Capital Group, and we are very active into dividends strategies. We have a managing dividend strategy for the past about 15 years. Okay, started with a Japanese client and Japanese fund house and whatnot. All right, so dividends very important because it's funded from the company reserve, and then they tend to grow in step with profits. As you may know, some fund might pay dividend quarterly, monthly for the unit trust. On ETF, we pay for this ETF, we pay every 6 months. Okay, semi-annually, and we only pay what we receive from the company, from the investment that we made. Okay, we don't pay out of capital. All right, so it also shows that there's consistent evidence that the dividend paying stocks they outperform. They outperform during the bear markets. All right, simply because the company can sustain. Okay, it's a sustainable business, so that's why they can set aside the profit and then pay out as a part of the dividend to be shared with the investor, and also is a commitment, okay, to dividends, align its company with the shareholder interest. It's very important. All right, so as you may know, some of the listed company, publicly listed company, AGM, there are a lot of investors questioning the management why there's no dividends, and or why the dividend dropped, or why the dividend was up. Okay, so you see, this is very important for the investors to expect their investment return. All right, so country-wise, just look at the table here. It shows that US is not that high in the dividend return, but compared to Australia, Singapore, Hong Kong, as well as Europe, okay, these countries are very, very highly relying on the dividend return. Singapore used to be very, very small portion. It was about 30 to 40% dividend return, but over time we have seen that the dividend return has surpassed the price return. Okay, it become a very important component, okay, in our stock market. Okay, so in Singapore, okay, Singapore company that pays dividends and is actually an attractive dividend market. Okay, Singapore STI, Singapore market is actually very, very good in paying so-called good dividends. Okay, for the past 12 months, you can see the dividend yield of this Singapore company is actually one of the highest among the ASEAN country. Okay, the ASEAN 5, after just right after Malaysia. So in terms of dividend yield, Singapore is not that bad. It's about 4.2, 4.3 kind of range. And the reason why we showcase you again this the dividend markets, and then goes to what, tied to the AAA, the AAA rating. Okay, Singapore is one of the top credit rating that received from the 3 rating agencies, Moody, S&P, and Fitch. Among the Asian country, we are the highest rating, even better than the USA. Okay, then I think not more than 5 countries in the world has this AAA rated, AAA rating kind of status. Singapore is one of them. Meaning to say, your investment, your client investment, your own investment, invest into this Singapore market, the dividend return is considered as high quality. Okay, due to the credit ratings of this sovereign credit rating, and at the same time, Sing dollar also fairly strong. Okay, versus the other country, the other currencies. So as you may see, from the past 20 years, for the past 30 years, okay, Sing dollar has been depreciating. Okay, if not still better than those early 90s, which is at Sing dollar 1.8. Okay, and to the current rates of 1.43, 1.44, something like that. Okay, so Sing dollar has been strengthened, okay, at the 1% annualized yield, okay, versus US dollar since 30 years ago. So it's a proven stable currency for investor to hold the investment. Okay, as a Singaporean investor, you might not aware that, okay, the dollar that you hold is actually very stable. okay, very strong because you invest in the domestic market. But when we market this concept to the foreign investor, especially the Thai pension fund, the Malaysian pension fund, the Chinese pension fund, or the European pension fund, they're fully aware of this phenomenon, the facts. Okay, so Singapore GDP forecast. We just look at what happening to around us. GDP grow for the third quarter was about 4.4%. So MTI revised. There's a revision. Okay, revised the GDP growth forecast in 2022 from 3.5 to 3.4. So actually, government tried to be a bit conservative so that we won't overpromise don't overpromise to the markets as well as others investors that invest in Singapore. And currently we are expecting about 4 to 4 plus, okay, for the whole year 2022. And as you can see, so the small graph, tiny graph below here. Okay, what I'm showing you here is that this is a recession. Okay, you can see the sharp drop. And during the 1985, during the manufacturing recession, it was bounced back as well. Okay, the GDP growth was negative, and then it was bounced back within 18 months. And Asia financial crisis in 1998, it was bounced back. As you can see the V shape, okay, the deep V shape. And so goes to global financial crisis, you will see a sharp rebound. But for COVID outbreak, we're actually expecting a wider V. Definitely the market will come back, but just at a wider V, okay, not a narrow V. Okay, so it proves that the economy has its downtrend as well as a peak. So by knowing all these crises, these kind of concepts, so you are able to judge or make a sound investment decision for yourself. Okay, like currently we think that the market is volatile, which is true. We share with the investor over the last month's seminar. October is volatile, and then November start to stabilizing. This is what happens. So you as an investor can plan your investment. Either you go one lump sum or you go by average down or on a regular basis. So what we suggest is go on a regular basis so that you can cushion down the volatility impact. All right. So when we talk about dividend, wow, is it a high dividend paying company, a good company? So you have to be careful. Why I say so is that during the financial crisis, a lot of investors putting money into the dividend fund, the dividends, whatever they promise dividend kind of strategy. But because you simply chase for going after this high yield, high dividends paying company, they might be of low quality. It might be low quality because of the company strength. Because they want to attract eyeball, they want to attract the investors' attention, so they can trick and simply declare higher dividend. So a lot of investors they might trap into this situation where they invest into a company that pay high dividend but no fundamental. All right, they are weak in their cash flow, they are weak in their businesses. Okay, so this thing happened during the U.S. financial as well as a global financial crisis in 2008, 2009, where people invest in some high dividend paying company, and then they get caught. They get caught. In the local term, we call it they stuck. Okay, they stuck in this investment. So that called dividend trap. All right. Same goes to the Singapore energy and material stocks in 2014, 2015 period. Okay. Of this falling commodity prices. So some investors might invest into some company, even though they are part of the STI index company. They are so-called good blue chip, okay. blue chip company, they also can fall into this situation where they are insolvent, or they have a cash flow issue and whatnot. So how to avoid this? How to avoid this when we think of this history and this problem, right, or this issue, and our management team, we decided that we would like to launch something that which is smarter, okay, can help the investor to sieve out the rotten potato. Okay, it's very important, company that pay high dividends, they might not be good because of they are weakening businesses, like what I share with you. They might be having problem with their financial. Okay, so high dividend stock doesn't mean it's a good bargain or good investment to hold. So you need to look at the strong company fundamental, the financial health, then in addition to this dividend yield selections process. Okay, so we actually work with Morningstar. We actually work with many index provider, okay, to come up this index. So we actually finalize the three important things. So this ETF is actually tracking the Singapore yield focus index. Okay, so it's actually working with Morningstar to come up this index, and we are looking at three criteria, very important. Number one, quality. What mean quality? Quality is the normalized value. Okay, they have a quantitative mood score. Mood meaning to say, okay, it's a Warren Buffett investment strategy, the value investment strategy. Okay, company like, I just give you an example, Telco, Singtel, M1, and StarHub. So among these three, Singtel has a better scoring, higher score. All right, so because of the competitive advantage, okay, over the rival. All right, so they have higher score. Company with this higher score, they will be selected. Okay, they will be automatically included, part of one of the criteria. Criteria number one. Criteria number two, financial health. Okay, company make profit. They have a so-called distant to default. How much loan they owe the bank, how much bond they issue out. Okay, what is their net cash flow, what is their forward forward cash flow, or etc. So second criteria sets in. So a lot of company might not be qualified. Okay, remember that. We used to have the top 30 Singapore index company, all right, part of the Singapore STI index. It was under this index because of the market cap, but those big market cap company might not be as good as a smaller one. All right, so second criteria. Third, we put in the dividend yield. Okay, for the past 12 months they paid dividend. Then only these three criteria sets in, then you press the button. Okay, of all the 700 company, we pick 30 company. All right, then each company can only cap at the 10%. We can only invest up to 10% of each company maximum. All right, so when you press the button, the 30 good company comes up. Surprisingly, it's different from the STI. We have a company like I will share with you, company which is we were shocked to see because we thought, hey, this company could not be qualified based on their market cap, may not be qualified, but based on their earnings, okay, their cash flow, they are qualified. All right, so business quality is very important, financial health also important, dividend adds in, okay, on this selection process. Then it makes it that this is an ingredient to make Phillip SING Income ETF. All right, so we look at the company financial health is a value of asset plus the asset risk plus the leverage, how much they IOU, how much they make loan. Okay, so this is a very simple way to run. By putting in this selection criteria, you are able to sieve out a lot of the a good company and the lousy company. So listen to the 4% dividend cut by quarter. This is the US one. They just talk about firms, stronger firms is financially and more secure dividend become. So this is they give an example. Okay, so under this selection universe, 6 stock exchange, 700 plus company, we put in this factor, then we come up the top 30 companies that we think that is good. It's not Martin Chong put in the strategy, keep changing. No, every 6 months we will run again. Every 6 months we will rebalance again. So it will rebalance. Those company that doesn't or didn't do well, they will be disqualified. Okay, simple as that. Okay, so over time, right? Over time, this index we have been doing the back testing and all this. Dividend return gives about 4+%, 4 point something percent, then plus the capital gain. So it gives about 3.4% annualized returns. If let's say we would put in the number right now, probably the total return get more because of the dividend return get more because of the price was down, dividend was steady, then dividend return percentage will be more. Okay, and capital gain is actually hovering around 3 to 4%. So it gives about 8.4% total per annum annualized return. Okay, for the past how many years? 2018 to 2022. Okay, so this is the cumulative returns, all right, that we showcase. We compare 2005 to 2022, all right. So it has a cumulative return because the dividend that they pay is actually accumulated, okay, and then it's compounded. It's not paid from the capital. Pay from capital drop a lot, okay. Then they cannot. It actually lost the compounding impact. All right, so no, this is not the case. For this, the cumulative returns for the past 15 years, 17 years, right, was 290% as compared to STI and even though Morningstar Singapore or MSCI Singapore, right? So the alpha is 1%, is very, very good. Risk is low, standard deviation is low. Okay, annualized return 0.4. So it's a very powerful classic example to showcase you this investment strategy. Okay, so we use a hypothetical 10,000 investment. You get at the end of this year, you get about become 32,000 as compared to others investment strategy. All right. So Phillip SING Income ETF is considered as a smart beta ETF, or they call it strategic beta by Morningstar. So it's actually smarter, not the ETF that based on the market cap. That is first gen. This is second gen. The third gen talk about the active managed ETF. So active managed ETF, they will be cost more, but at the moment it's not ready to launch in Singapore yet. All right, mostly we see all smart beta strategy. So very simple, 30 high quality company, okay, SING Inc, Singapore Incorporation, fully replication of this Morningstar's Singapore Yield Focus Index. So it's actually 100% copied. The moment the index on the third Friday afternoon, so the moment the index rebalance, then we will our dealer will automatically follow the allocation by the set by the the index. So it's actually 100% copy their strategy. So it's considered as a passive investment, but it's a smart beta because of the selection criteria, right? So it semi-annual distribution June and December. We just cleared 2 months ago, and then no, 3 months ago, 4 months ago. Then now we are expecting another one in the payout will be in January. All right. So portfolio will rebalance every 6 months as well. Okay. So stable, significant income, okay, very suitable for the investor to invest. Most of the investors, some will ask, I don't know what to invest, what to buy. You buy this SING Income ETF. Why? One stock will allow you to expose to 30 high quality Singapore company. All right, simply to say, or it's very straightforward, easy to understand thing. So it's a passive allocation to Singapore market. Okay, emphasis on the quality, financial strength, as well as the dividend, and very liquid. You can cash out any data. You can sell your ETF through Phillip Nova at ease, very easy. And those who are expecting dividend per annum, I think it's about 4% range, or 4% range really. Okay, this is the stock code is a OVQ, and then or you can just Google the name or check the name. SING Income, Phil Sing in INC. Yeah. So this is what you can see from the fund fact sheet. All right, year to date they are flat, okay, about 0% return as compared to some of the so-called foreign stock or foreign index. They perform badly, okay, mostly all double digit. And SING Income ETF, they actually have this semi-annual dividend. Okay, dividend yield was 3.49. I think the next one, January 2023, if the market keep going down or stagnant, right, or stagnant, we probably get about 3.8 to 4% or slightly over 4. Okay, so the sector allocation is slightly different from the STI composition. All right, well, we only have 40% in financial, whereas STI has more skewed towards financial. So they underperform STI. It was because last year and this year the banking stock was outperforming the markets, and they have REITs as well. For this ETF, they have 20% allocation into REITs as well. It's not they purposely allocate, just that they are qualified, okay, due to their cash flow and qualities. All right, and you may know, for your information, 50% is actually government-linked company. All right. Okay. Selected economy, real GDP growth, we're actually expecting about 4% this year, and then the next year lower. Okay. And the inflation is higher. Inflation is about core inflation about 5%. We see it will be higher. Okay, as you may know, your fried kway teow or bak chor mee already the price already up more than 10%. So that is a phenomenon. Okay, it's a phenomenon that inflation will tilt outward. Inflation will tilt outward. Okay, inflation. GDP growth will still keep going, but at a lower rate. Okay, at a lower rate. Okay, so key takeaway for to share with you about this on this seminar is that we are at the road to recovery and the normalcy for Singapore since April. We see a lot of good result of this listed company, as well as the REITs operator. Okay, they're doing all right. Bank are doing very good. The top local bank like UOB, as well as the DBS, their quarter profit is about 1 billion. So each year make about 4 to 5 billion. All right. So nonetheless, next year will be a challenging year. Okay, slowing down and whatnot. So the earning will be cut as well. But let's look at our GDP currently. It's about 3 to 4% for 2022. Okay, so some of the investors will ask us this question: is it similar to 2008 global financial crisis? Slightly different, because most of the company has stronger balance sheet now. Okay, sector to consider. All right, so You might look at the consumer, property, developer, hospitality, not yet. Airlines also not yet. We only see some small recovery. And then airline is charging very high ticket prices. Will that be a trend in 2023? We are yet to see. Okay, banks, retail banks are doing all right. They are doing all right as long as they are not in investment bank. They do all these derivatives product, they do structured product, in very high risk, very highly geared or high leverage kind of products. They are okay. Okay, if they involve in this high leverage product, high geared product, then they might not be okay. Okay, the classic example is okay, Credit Suisse. All right, long-term buying opportunity, yes, we go by average investment strategy. That meaning to say you don't put your money in one go. Okay, spread it to 3 to 4 kind of tranches, or you create a regular savings plan or regular every month just put in on a regular basis so that you can avoid the volatility of the markets. Okay, we prefer to be positioned in a company with conservative balance sheet and strong financial health, because this fund, this ETF is actually a passive one. Okay, passive one. So we don't simply change it, change the underlying from time to time. We will just rebalance one time, and then based on the selection criteria, selection process, and it proven since the launch, it has been holding quite well. Okay, so Sing Income ETF started a smarter way to invest in the Singapore stock. A lot of investors, they don't know what to invest in Singapore. Okay, what stock to buy, which company to follow. So this is a best investment strategy. It's an evergreen strategy. Allocate 20%, 30% into your investment portfolio. Then you will see the regular income as well as you have a good night's sleep. Okay, this kind of strategy. All right, so very interesting part. Let's look at some. We do some not game, just to test your eyesight. Okay, which company you like the most? Okay, let's talk about this company that which is very popular during the lockdown. Okay, Sheng Siong. Okay, when this ETF, this index included Sheng Siong into the index, we were all surprised. It was before the lockdown. It was early 2020. It was January 2020 when the just rebalancing in the December time. So we were puzzled, why Sheng Siong? And then we tried to check but further. Yeah, the cash flow is there, and then the financial health is there. And true enough, when during the lockdown, the share price go up further because of the profitability, and then people lock down, and people tend to shop more at the Sheng Siong's premises. So not only Sheng Siong, okay, we see company like SGX also, Singapore Exchange. It was included at the top 3 back then when the share price was below $5 or something, $6 or $4 plus. All right, so it was selected and then placed in the number 3rd. Okay, placed in number 3rd rank. Okay, right after the OCBC Bank or UOB Bank even back then. Okay, so it was selected due to their financial strength. All right, no magic, just data crunching. Okay, all right, so I will stop right here. This is just talk about the growth and the uses of ETF. Like this is a growth, is at a very high growth trend. All right, more than 6 trillion in the assets. Okay, rest in this ETF. All right, so I will stop right here, and then we will open the Q&A to the floor.
Members of the audience, if you have questions for Martin, you can type them down in the question box. You just head to your control panel somewhere at the bottom, you'll see a question tab. Click on it, and you can type your questions in there, and we will direct them to Martin. Martin, we have a question from Charlene. She's asking if she can buy OVQ, which is the name of the stock, in case you want to add it to your watch list, from Phillip Securities. Yes, you can. You can buy it from Phillip Securities or Phillip Nova. Both of us carry this ETF. And Martin, this follow-up question from Charlene is, what is the minimum subscription amount? I mean, you mentioned
Minimum,
that yeah, minimum
I
subscription
think,
amount.
okay, minimum is $10, if I'm not mistaken. $10. I think it's very, very small because the SGX break it to very, very small breakdown.
All right, so it's in a very small. I mean, you can get it in a very small quantity, but typically you might want to space out your purchase of the ETF, so you can ride the volatility, or maybe like what you suggested, you can use a regular savings plan as well.
Yeah, the trading board lot size, sorry, it's not 10, it's a 1, but actually we don't encourage you to buy 1 unit, right? Because of the brokerage and whatnot. It's good that you participate in a larger amount, so that it makes sense. You buy 1 unit to pay, let's say, pay 2 cents of dividend, 0.02. So what is the amount? You can't even receive the dividend now. Yeah.
Hey Martin, Michael is asking, can we use SRS to purchase the ETF?
Yes, you can. Yes, you can. Yes.
All right. So you mentioned the why the value proposition of this ETF is very compelling, because there's a few layers of process to ensure that you select the quality companies from Singapore. I mean, it is most investors, when they start out, they think that the S&P 500 is something they should start with, or the STI. Maybe you can advise on what is the value proposition of this ETF, Sing Income ETF, once more for us.
Sing Income is the regular income strategy with the quality company, whereas the S&P is a growth stock. Okay, S&P company doesn't have good profit. Okay, a lot of them don't even have good convincing the cash flow or financial strength, okay, to convince us to invest into their company, simply because they are all growth company. So growth company was affected during the downtrend, okay, since the third quarter of last year. We see this tech company or fintech, they are into a fairly scary negative returns performance zone. For example, fintech lost about 50 to 65% year to date easily, and the value proposition is definitely not the same, because when you invest, investors tend to look at the growth story, but you must fully aware that your investment is to grow over time. It's not like you're punting a stock, you're punting a strategy that will give you returns 20-30%. No, it has long gone. Fintech was what I said 1.5 years ago, or about 1 year ago. We said 2022 or 2020, end of 2021, it was a burst of fintech or venture capital. So it was true. And then we see semiconductor, the microchip company. 9 months ago, it was under stock, okay, under stock, and then the shortage as well. But now what is happening in the semiconductor industry. It's overstocked and oversupply. Company are cutting staff. Okay, those well-known company, including Foxconn and all these, they are cutting their staff number, staff strength, and this is a real scenario that next year it will be a slow year. All right. Nonetheless, okay, as compared to the S&P, STI is holding very well. Singapore stock has been doing fairly well. Okay, I think one of the top performer in the world, except the commodity. All right, except the commodity. So we are doing fairly well, and what you see is what you get. The good stock, good dividend paying stock, good quality companies. Okay, it is different from S&P. S&P is it's a grow company, or MSCI World. Okay, MSCI World is actually different from S&P. S&P is typically a growth company, growth stocks, and in the index. So you can use that strategy when the market has been beaten up to the floor. Then you take that strategy. Okay, you allocate some, but don't use it now because they are still at a bad trend. Okay, all right. So any the next question?
Yes, we do. We have a question from Charlene once again. Charlene is asking what's the annual dividend percentage like. I believe you touched on this. Would you be able to share more, Martin?
About 3.4, about 3.4 for the previous one, and then the market was the so-called share price came down a fair bit, so we expect about 4% the next 2 months. In January, end of December, we'll probably know already. Yeah. So the yield is about 3 point, I think close to running yield is about 4%. The running yield currently is about 4+%, 4. So next year we probably will be able to, we expect about higher dividend than July.
Hey Martin, Michael is asking, besides dividends, right, will the ETF grow in value? What's your thoughts on this?
Yes. Okay. Very good question, Sri. Let's look at we talk about the capital gains for the past 15 years. And this is data from, this is the 4 years data. So if I say I were to drag longer, the return is higher. I can tell you, if let's say you compare 2008 and now, definitely higher, but I don't do that, you see. Generally, we expect dividends about 4 to 5%. Capital gain, we actually expecting about 4 to 5% as well. So previously, when we run the data, which is the 15 years, 2005 until now, the return was remarkable. It was about 9.8 or 9.9 or close to 10% per annum. Annualized per annum. This is a per annum return. Okay, annualized return. So we expect capital gain about 4-5%. So at this juncture, of course, the market is a bit weak. But we look at the next 5 years down the road. 5 years down the road, definitely you will see again the annualized return will be, the total return will be close to 8 or 9%. Okay, this is proven. This is the track records that has been showing. Okay, dividend return has been doing very well. Dividends return has been paying about 4 to 5%. So capital gain also we see another 4 to 5. So you get about close to 8 to 10% kind of returns.
Hey Martin, so Charlene is asking, is this an annual dividend or how often do they pay?
Okay, every 6 months. You can see the we pay every 6 months. Yeah, we pay dividend every 6 months, January and July. Just imagine, okay, when close to Chinese New Year, you get dividend. Okay, when close to mid-autumn, okay, or the Raya time, you get dividend. So you invest in few of PCM, Phillip Capital Management's ETF, right? The whole year round, you will get dividend. Every 3 months, you get, every quarter, you get dividends. So this is one of our strategies that we keep launching, all the dividend kind of strategy. Makes sense to the moms and dads, retiree, to the working professional who like to grow their money. Yeah, that makes sense.
I have a question for you. In terms of while we're waiting for more questions from the audience, is there a particular? I mean, is there a reason why we have higher government or Temasek linked stocks making up this ETF? Is that a good thing or a bad thing, or is that a good indicator of quality companies?
Okay. Yes. A very interesting question. This question has been asked by one of the pension fund as well, but not one or two pension fund. We are showing the, actually this is indirectly the confidence to the investors. Government linked company always has better cash flow because of the strong parentage, strong backing. Same goes to the REITs operator like CapitaLand, Keppel, Mapletree. All right, so these are the government linked company or Temasek linked company that able to grow, okay, able to add value into their asset, whatever that the investment that they have. That is naturally these are indirectly also it showcase that to the investors that the quality of this company, the quality of this company. It's actually we when we do this research, right? We did this many years back. We're just trying to see is there any non-government linked company, which to our surprise that we found more than half, about 53 to 55% is actually owned by. It's a very natural way, and government also invest into the country, right, into the company. So most of the company are well run. Okay.
All right, Martin Michael has one more question. He's asking, should he invest monthly or via lump sum in view of the current market correction that's happening right now?
Invest into the monthly basis, because unless you have a crystal ball, you say, oh, this is the bottom already. But our suggestion is that go on a monthly basis as well, on a regular basis, unless you really think that you have confidence. Okay, you really think that, okay, my gut feeling tell me that it's bottom up already. Then, because if let's say Ukraine war settle, then you see the sign already. You see the sign, it's ready to go in. All right, and or you see a lot of good news coming along. Not the barber or those selling bak chor mee to tell you to buy stock. That is the time you should sell your investment. Okay, whoever a non-investment related person come and tell you, hey, a good time to go in, then it's good time to say bye bye to the stock. All right, you buy when people say, yeah, don't trust the company, don't trust the market and all this. Yeah, so you accumulate. Okay, and at the same time, you are not like Warren Buffett. or you are not the fund manager. So fund manager can make mistake as well. Then you good strategy would be go on the regular basis. Unless there is a good new firm confirm everything, then okay. But at the moment, very unlikely. The market is volatile. But just that the STI, the Singapore company are performing. Yeah.
Right, we should have time for 1 to 2 more questions for Martin. Martin, maybe while we are waiting for the last question, would you be able to walk us through the key takeaways for us today?
Okay, so let's look at the points that we highlighted here. Road to recovery. What does it mean? And normalcy. I mean, people go back to our life back to normal. More people in the mall. Okay, so it translates to what? Spending power has been up. More F&B has been reopened. Okay, before that, a lot of F&B been closed down. Some hawker or been operating for 50 years, 80 years, also closed down. So it tells you, okay, recovery, but not the boom time. Okay, it's a recovery. So cash flow is there. It benefiting who? Retail, F&B. Okay, hospitality is not yet. All right, although some of the hospitality REITs has performing fairly well, about 20%. Okay, but that is another story in that case, because people are expecting like airline, are they doing well? No. For your information, SIA is still in the red, right? So but the prospect is there. The prospect is there. So in recovery mode. All right. So these are the strategies that you should consider. Like Michael asked, should you go on a regular basis or lump sum? So you go on a regular basis. It's more makes sense. And Singapore GDP 3 to 4%, meaning to say we are still at a positive range. We're not stagflation. Okay, we still grow a bit, but we have a high inflation. That is not stagflation. Okay, no growth, then you high inflation, then you consider stagflation. But at this moment, we are not yet. Okay, we are. So not even talk about the recession thing. No, not in Singapore. Similar to global financial crisis, at the moment, no. The company that even though Singapore company, we talk about, let's say Singapore context here, they have a stronger balance sheet now. Okay, so let's say as an investor, what to buy? Bank, airline, healthcare. You don't know what to buy, right? Buy this ETF because it actually allows you to expose to the sturdy company. So yeah, makes sense. And long-term buy opportunity, we always believe that you go on a regular basis. Yeah, then you don't have to worry about the market volatility. We like company that has a strong balance sheet. All right, that's why this investment strategy, this idea comes in. This idea comes along. All right. First, we talk about investor put in money into some water filtration company, some commodity trading company, and this company gone into a insolvency stage. Then investor did a protest at the Hong Lim Square, so or whatever. So from there, right, actually give us an idea head up that we should plan something, some sensible product, so that investor will help investor to select the good company. That is very important. So that's a formation of this product and the other ETF as well.
Hey, Martin, I have a question for you. I mean, looking at our inflation rate for 2022, we are looking at, I mean, correct me if I'm wrong, we are looking at about 4 to 6%. Is that correct?
Yeah.
So with this product, with this ETF product, how can we use this product to beat inflation?
Okay, our inflation is only for this year and maybe for next year, and we also see an upside potential for this ETF. So with the combination of the dividend returns and the capital gain, okay, so over time it's actually proven that annualized about 8%. So it's certainly it beat the inflation over time. It beat the inflation. I don't think our inflation will stay at 6-7% for the next 5 years. I probably one or two, maybe maximum three. Otherwise, it will be very tough for the bank and insurance company as well. Okay, also bad to our economy. That kind of inflation will be very very bad. First thing happen will be the devaluation of the Sing dollar. Okay, so that is a something that our government very particular. So high inflation, it could happen, but very very high, very unlikely because of the strong currency. So this is how we hedge, okay, against the ASEAN countries' currency like ringgit, like rupiah, like Thai baht. We are actually, even though we are facing a higher US dollar rate, all right, but we at the same time we also strengthening. Okay, we go aggressive a little bit. Our central bank MAS, they went aggressive. I think the 14th of October, we just announced that we will go a bit aggressive, slightly. We strengthen our Sing dollar. I mean, our import will become cheaper from this country, and it makes sense. Okay, our core, that's why we say core investment or core products like rice, flour, and all this, we're all imported from ASEAN country. So your imported product imported product become cheaper, okay, because of the currency. So this is actually cushioning down the impact of the inflation as well. So this is how we manage our inflation. All right.
We have a very good question as our last and final question. This is from Janice. Janice is asking, is the Sing Income ETF the same as STI ETF ES3?
Not really. Okay. This is the comparison. Okay. STI has a component. This is a STI, and then this is a Sing Income ETF. Sing Income ETF has a smarter selection process. That means the three steps put in place. STI is just based on the market cap. The larger, the better. Remember the story that I shared with you. The water filter company was part of the STI, right? Then what happened? Investor bought their share and all this, suffered losses because the company went into insolvency. And another commodity trading company, start with I don't know, mention the name, all right? Start with N. Then also got into trouble. And then people went to where? Went to Hong Lim Square and protest. So because of this phenomenon, we think that it's good to come up with something which is different from the STI. STI just based on market cap. It was so happened when the financial stock was moving, all right, for the past 1 year ago, about a year ago, banking stock was moving, and because of the higher component of this financial stock, they did perform a little bit better than this Sing Income ETF. But overall, in terms of the selections, why I believe that our Sing Income ETF is proven, and it will do better over the long term. You can see the performance. They are doing very well. Where did yeah, over time they actually outperform STI so much, from 2005 to 2022. Okay, so this is the actual number that we would like to share with you. So it's a different. STI is just based on market cap. You have the largest market cap, then you are qualified. But just look at our the underlying those company like Sheng Siong, they are not top 30, but they're not top 30. But if I'm not mistaken, their quarter earning was about 31 million. Their quarter earnings profit. So it's better than those are insolvent. So they could be part of the STI component. Yeah. This is what I'm trying to give you a comparison wise. Okay.
All right. Thank you so much, members of the audience. Thank you so much, Martin. Martin will be sharing with us a video that we can share with you to better understand the Sing Income ETF. And we'll also share a link to a video recording of this webinar so you can catch up on the insights that Martin had shared. Martin, thank you once again for your insights. And members of the audience, thank you once again for attending this session. To our next session, do look out for our upcoming EDMs on our upcoming webinars. We'll do our very best to arrange another session with Martin. Maybe he can share with us more insights on this ETF or other ETFs that he has that you might be keen to check out. Martin, before we let you go, can you just do a confirmation of the stock code for the Sing Income ETF?
The OVQ?
OVQ, there you heard it from Martin himself. Members of the audience, if you're keen to check it out, just go to your Poems or Phillip Nova platform and search for OVQ. All right, and that's all for today. Till our next webinar, we'll see you then. Take care, stay safe, and all the very best in your investments. Good night. Bye-bye.